All right, so where we had left off on the Coca Cola valuation is we had set up a model where we had forecasted the financial statements of Coke. And based on these forecasts, we want to now do a valuation. Okay? So what we're going to do is we're going to add another tab to our model. I'm going to add it over here on the far right, and we're going to call this DCF Valuation. And basically, this is going to be the cash flow valuation of Coca-Cola. So if you go back to what we had talked about a few weeks ago, when we introduced the valuation methodologies, I said for DCF valuation, the book had talked about Home Depot, and there was a slide in there of how they had valued Home Depot. And I said it was a very important slide because I said that's going to form the basis for the valuation that we're going to do. So essentially, that's what we're going to put in here. So if I go back to that slide in the lecture notes, when we talked about the process, this was basically the process that we're going to put into our model. So the first part is we need to do the operating value of Coca-Cola, forecast that, and that's based on our forecast of free cash flows. So in our model, and just so we can print it all on one page, instead of going across the columns, I'm going to go down the rows, we're going to start out by listing the free cash flow, which has been forecasted on our CFI for all of the forecast years. So equals our first forecast year, which I'll get off the ratios tab, was 2014. And I'm making a relative reference here to that. And the reason I'm making a relative reference is if we ever change the year in the model, then I want the model to automatically adjust. So again, we don't want to hard code the year references. And we're going to forecast 10 years. So equals previous year plus 1 all the way through 2023. Now, year 11, 2024, we forecasted in our model, but 2024 is going to become the first year of what we call the continuing value period. So again, as the book talked about when we did our readings last week, you always forecast one more year than your actual defined forecast period, because that final year is always the start of the continuing value period. All right, so you always need a T plus 1 or an N plus 1 period when you do your valuation forecast. So in this case, we did 11 years, 2014 through 2024. So that first 10 years, 2014 through 2023, defined forecast period. For us, 2024 becomes the beginning of the continuing value period. So where is our free cash flow? Well, that was on the CFI tab. On the CFI tab, we had forecasted essentially the income statements and balance sheets, which gave us the converted forecast of free cash flow for those year periods. So I just want to put those into this sheet. So for 2014, there's equals from my CFI, 2014 free cash flow, which is H12 off the CFI, 2015 free cash flow, 2016 free cash flow, 2017 free cash flow, 2018 free cash flow, 2019 free cash flow, 2020, 2021, 2022 free cash flow, and the 2023 free cash flow forecast. HIJKLMNOPQ. Right? And I'm just going to format this one decimal place, just make it a little bit cleaner. All right, so those are the forecasted free cash flows for Coca-Cola, assuming that our ratios come true. So what we'll next do is I need to put these into present value. So what I'm going to do is I'm going to multiply this by a discount factor. So in this case, discount factor is 1 divided by 1 plus R to the number of periods, T or N. So we need a R, and in our model, R is going to be the weighted average cost of capital. So we're going to use the WACC as a discount rate. Now remember, for enterprise DCF valuations, one of the assumptions of enterprise DCF valuations is we target a target capital structure. So therefore, since we're assuming the capital structure is not changing in the firm, we use one WACC, or one discount rate, across all the future horizons. So in this case, I have a WACC in our model, which we'll adjust a little bit later this morning to a more realistic WACC, but it happens to be 7.8% as a starting point. I have that as one of the assumptions. So what I'm going to do is my discount factor equals 1 divided by, left paren, 1 plus, from the assumptions tab, the WACC. I'm going to copy this, a few down, but when I do, I want to make this an absolute reference to cell B4 in the assumptions tab. So a dollar sign in front of a B, a dollar sign in front of the 4. And then I want to copy and paste this down. But then starting in year 2, I want to take this to the second power, which is shift 6, the caret key, squared, 1 plus R squared. Third year, 1 plus R to the third power. Fourth year, 1 plus R to the fourth power. Fifth power. Sixth power. Seventh. Eighth. Ninth. 10th. So 1 plus R squared, third, fourth, fifth, sixth, seventh, 8, 9, 10. So therefore, my discounted free cash flows equals the free cash flow times the discount factors. That's the present value of the free cash flows. When I sum these, that would be the operating value first 10 years. So what we've basically done is we've now, assuming our model comes true, we forecasted the free cash flows for the first decade. That's the operating value of Coca-Cola selling their soft drinks for the next 10 years, approximately $50 billion. Right? But here's the thing. Coke's not going to stop doing business in a decade. We assume as a company that they continue on. So we need to then do a continuing value period. Well, when we do continuing value, as talked about in the book, then the key value driver formula, which is one of the reasons why we did it earlier this semester, is going to be used to value the company during the continuing value period, right? So in this case, what we're going to do is we're going to say the continuing value, we need 4 things. We need no plat in T plus 1. T plus 1 is 2024. And that was that first year of the continuing value period. We need a growth rate, long-term growth rate. Third, we need a RONIC. RONIC is the return on new incremental capital. For our purposes, it's going to be the 2024 ROIC. It's the ROIC in the continuing value period. And we need a cost of capital. So those are the 4 things we need to do continuing value. So we're going to create a formula here for continuing value, or CV, using the key value driver formula. And I'm going to put all of these items into the assumptions tab, just so they're all in one place if I ever need to change them later. So again, we need 3 more items because there's the WACC. I need a continuing value NOPLAT. I need a continuing value G. And I need a continuing value ROIC. Or RONIC. Right? So my continuing value NOPLAT is going to be my 2024 NOPLAT. I'm going to find that on the TII screen. So on TII, we have a forecast for NOPLAT, 2024, cell R4. Continuing value G, 3%. And you might say, why did I pick 3%? And the answer is because what we want is, think of it as a 20 to 30 year growth in cash flow. When a company is mature, eventually it's probably going to start to grow at a rate similar to that of the economy. So the long-term growth rate of the U.S. economy is somewhere around 3%. At least it's been that way the last 100 years. There's an argument that maybe it might be a little lower in the next 100 years, but right now people are still assuming it's going to grow at about what it did the last 100 years, about 3%. So essentially, we're going to start out with 3%. But generally our ranges for G are going to be between 0 and you can't go higher than your cost of capital, given the formula for growing perpetuities. So 0 in the cost of capital. But essentially, in this case, we're going to say we're going to start it out at 3%. And our continuing value ROIC, this is very important, is going to be based on the beginning of year ROIC calculation, as opposed to the end of year ROIC calculation. And the reason why is because when we do the economic profit valuation, we want our DCF and economic profit valuations to be identical. The only way they're identical is if we use BOY ROIC. So we go to the EP BOY tab, and we want the 2024 beginning of year ROIC after goodwill. So in this case, row 15, BOY ROIC, BOY tab, row 15, Q15. And these are going to be yellow cells because theoretically I could change those in the future. But for now, I'm using the forecast that I have created. So I have the 4 things necessary right here to do continuing value. So let me go back to my DCF valuation. So what I'm going to do is I'm now going to take this formula and put it into the model right here. So equals, starting out, NOPLAT. So go back to my assumptions tab, get it all in one place. Times left paren 1 minus the growth, CVG, divided by the RONIC, continuing value ROIC, right paren, divided by left paren, the WACC minus the CVG. So approximately 110 billion. So the toughest part of this assignment is just basically getting the correct order of operations in Excel. Right, so that is the formula that we basically just used. So what we've done is we figured out what is the cash flow of Coca Cola from 2024 onward. Now, as part of a growing perpetuity, the growing perpetuity actually includes a discount rate. So therefore, what we've done is we've discounted the value, the continuing value, to the beginning of 2024. Right, January 1st, 2024. That's the present value of that date, which for all intents and purposes is the same as December 31st, 2023. So what we're going to do is we have to present value this continuing value. So what we're going to do is we're going to use the same discount factor because we don't want to double discount the year 2024. The year 2024 has already been discounted by the growing perpetuity formula. the key value driver formula rearranged. So therefore, we don't need to discount 2024, but we still have to bring it back to a present value, hence why we're using the same discount factor, equals free cash flow times discount factor. That's the value of Coca Cola into the future, assuming that these ratio assumptions hold true. So about $50.3 billion of value in the first decade, about $52 billion going forward, which means that we have an overall operating value equals that plus that, a forecast of about 102 billion and change. Take this whole row and format to one decimal place or column. All right? Questions about that? That's our one value. Now we need to go to our twos. Now we need to go to the non-operating values. Okay? Because we're going next to enterprise values. Operating value plus non-operating value equals enterprise value. Well, this is where the TFI helps us out, because we have identified the three major items that we have to value as non-operating assets: excess cash, non-operating assets, long-term investments, and receivables. So what we're going to do is I'm just going to list those three. These are my three non-operating assets. So here's the assumption that we're going to use. We're going to use the last year, or in this case, last reported year is 2013, the current value of each of these. Let's go back to my TFI, 2013, excess cash, non-operating assets, long-term investments. So here's the point of these three items, which is, if you think about it, cash is cash. So therefore, we don't have to present value cash, because it's already present value. It's the current amount of cash that the company has, and that's the amount that can be distributed today, because we're already looking at the valuation of Coke today. So it's the amount of cash that they have. If they liquidate their non-operating assets, theoretically, the balance sheet value should give us that value of about $22 billion. That's the value of the non-operating assets minus the non-operating liabilities. And then we have the value of the long-term investments. If we add these three things up, we then get what's known as the enterprise value of the firm. And add in the operating value. So, once again, the operating value plus the value of the value of the non-operating assets equals enterprise value. So about 145 billion. So there's an assumption that we're making implicitly here that future income statement non-operating gains and losses are basically NPV 0. That's essentially what we're saying. Okay. So we're going to use the present value of the non-operating assets, which is the value on the balance sheet, and we're going to assume that those aren't really going to change in the future, and that everything else would just be NPV 0. Right? Because again, we invest in companies not because they're good at running their non-operating assets. We invest in companies because they're good at running their operating assets. And since they're probably not good at running their non-operating assets, those should be close to an NPV 0 proposition going forward. Right? Those are the implicit assumptions we make. If for some reason you run into a company that's different, you can obviously make different assumptions, but this is the most common one that's used. So here's the thing. There is one item that could be different, and that is the long-term investments. Right? Because what we're doing here is we're using the reported 2013 values for Coca Cola, which is the book value on the balance sheet. Well, the book value of cash is probably the actual cash, so we don't have to worry about that one. The book value of the operating assets and the operating liabilities, without any clarity, we know that they're probably at least somewhat realistically valued by the accountants. The one problem we have is the long-term investments. And the reason why long-term investments is a problem is because of the accounting rules. And what the accounting rules say is that they put assets on the balance sheet at what? How do accountants put out assets on the balance sheet?
Historical costs.
Historical costs. And what happens if the historical cost is wrong? What happens if the value of the asset deteriorates?
And you say can write it down.
You can write it down. You can impair it. What happens if the historical value of the asset appreciates?
They leave it at historical.
They still leave it at historical cost. That's the one challenge. So what we kind of know for the long-term investments is that it's probably a ceiling. It's probably a floor, but it's not a ceiling. Meaning that if they've lost value, they've probably written it down. But if they've gained value, they haven't written it up. So that's the adjustment that we're going to make. So on the assumptions tab, and again, it's the assumptions tab where we're putting all of our miscellaneous assumptions in one place, just so they're easy to find. What I'm going to do is I'm going to call it the price to book multiple of long-term investments. I'm going to start it out at 1, and again, make it yellow because that's something I could change. And then I'm going to come over here to my valuation, and I'm going to take my long-term investments, and I'm going to then multiply that by that price to book multiplier. So, price to book, again, as you read in the McKinsey chapter reading for this week, basically says what is the stock price divided by the original investment, the book value. Price divided by book of equity. So in this case, if I use a price to book at 1, I'm using book value. So I keep the multiple starting out at 1. But let's say I'm Yahoo and I bought Alibaba, and Alibaba is worth a lot more than what I paid. Then the price to book multiple for Alibaba, I could figure out based on their market price or perceived market price, and then I could adjust the value. So if I thought for Coke, I'm mixing metaphors here, but that my price to book multiple were 10, then the model would then adjust the value of the long-term investments by a multiple of 10. Okay? So if I knew what this long-term investment that Coke made was actually worth, I could use the price to book multiple to adjust it to a market value. If I have no idea, then at least at a minimum, I have the book value that's being reported. So since I don't really have any idea, I'm going to leave it back at 1. But if we were really valuing Coke, we'd want to have an idea. We'd want to find out what these are and try and get some sense of what we thought they might be worth. But nonetheless, this gets us an enterprise value. Questions about that? Okay, easy enough. So now what we have to do is we have to go from enterprise value to stock price. Now, shareholders, common shareholders, are the last to get paid. So what we have to do is we have to subtract everybody else that's owed money, and whatever's left, that residual, is the value of the common equity. So again, this is where the TFI helps us, because on the TFI, it lists what is owed. Right? So in this case, what I'm going to do is I'm going to go back to my DCF valuation equals TFI, take out retirement-related liabilities, take out interest-bearing debt, take out not common equity, because I'm solving for common equity, take out the preferred shareholders, and take out the minority interest. So once those 4 people are paid off, then what is left belongs to the common equity holders of the firm. So in this case, retirement-related liabilities, 2013 value, and again, we didn't predict that it would grow, and the reason we didn't predict it would grow is because companies are not allowed to grow their retirement-related liabilities under accounting and U.S. government laws. So basically, over time, they have to fully fund their pensions. So whatever liability they have, everything else, NPV 0. So current amount. Same thing with the interest-bearing debt. equals off of TFI, I'm getting this data, the 2013 interest-bearing debt that's owed. Any preferred stock they owe, it's 2013 preferred stock, and any minority interest, TFI minority interest. So what that would get me is a common equity value equals enterprise value minus the sum of those four things. About 106 billion and change. Questions? All right.
What are you adding there? I'm sorry.
So I just basically just took that minus those four things. Because again, those are the people that have to be paid off, and then once they're paid off, the rest of that cash flow in present value would go to the common equity holders. Okay. Questions? All right. So you'll notice I left in a blank line here. And on the Assumptions tab, down here at the bottom, I pulled some things from, and this is the nature of the Bloomberg balance sheet. When you export a Bloomberg balance sheet, it lists the assets, the liabilities, and equity in the standardized format. But below the standardized format is a section called reference items. Reference items are basically things that are coming from the footnotes. Okay? So they're not directly on the statements, but they're other key data points that Bloomberg is aggregating and putting in associated with the company. Again, the challenge for the reference items section in Bloomberg is they're not consistent company by company. Okay? So they try to be fairly consistent with the standardized statement itself, but the stuff that's in the footnote isn't always consistent. So here's the thing. The reference items are different by company, and they can show up on different rows, which will cause a problem for us. But one of the reference items that they'll typically have is something called the operating lease value, which is the current value of the minimum operating leases that are owed. Right? Now, when you do the reading in the book about operating leases, basically what we want to do is we want to strip out the notional value of the lease from the interest value of the lease and present value of the operating lease to basically capitalize the operating lease. Right? But here's the thing. For our purposes of simplicity, what we're going to say is rather than doing that as we set up the model, just because we don't have a huge amount of time in this class, I'm just saying if you do this professionally, you should capitalize all the operating leases. And then you should adjust your income statement for that capitalized value, and you should adjust your balance sheet for the capitalized value of the operating leases. Right? And then you subtract out the principal of what's owed, just like the principal of the debt. Right? But for our purposes, I'm just telling you that the math is not going to be too different than as a shortcut we're going to take if we just subtract the notional value of the operating leases, which are not in a present value format. And that's the other thing. We got to present value these, and Bloomberg is listing the notional value of the operating leases that are owed. Right? So it's not perfect. It's just going to be a proxy, but we have to have some value of this off-balance sheet financing that's got to be paid before the common shareholders get paid. Okay? So that's what this line is really representing. And so what I'm going to care about is the most recent value of the operating leases, 1,045, which I'm picking up here off the Assumptions tab. And because it changes company by company, I'm going to always want to pick it up off the Assumptions tab. So what I'm going to do is I'm going to say the value of the operating leases, the off-balance sheet financing, equals, from the Assumptions tab, the 1,045,000,045. So therefore, what I'm actually going to subtract is those 5 items. So I get to about 105 billion. So that's what's going to go to the shareholders after everybody's been paid. Now, I next need the shares outstanding. And on the Assumptions tab, that's going to be another assumption I'm going to make. And the reason I'm going to make it on the assumptions tab is the shares outstanding is going to change company by company. So therefore, I'm going to want to be able to quickly update it, remind myself to update it. That's why I'm not going to put it directly on that tab. So in this case, shares outstanding, we are going to find off of the DES screen. Is the easiest place to find it in Bloomberg. So once you go to a company, DES is description. On the first page of the description, bottom left, current shares outstanding. So for Coke, 4395.2. So 4395.2. So on my valuation, I'm going to refer to that shares outstanding assumption. Change that formatting because it's not currency. And then what I'm going to do is I'm going to get a forecasted price per share, which equals the equity value divided by the shares outstanding. So basically $23.94. So if all these assumptions come through, about $24 a share price. Yeah.
So why would the shares outstanding differ from the balance sheet data tab from Bloomberg? Is one diluted?
One could be diluted. It also is, the DES is literally the most current number reported, where the balance sheet data tab would have been the December 31st, 2013 numbers. So there's also a timing difference between the two. So what we want when we do the valuation is we want the most current data, because we're doing the valuation as of today. Because what's going to matter to our valuation, to be honest with you, is the expected cash flows anyways. So we want to know as much of the future as possible. So we're using current values. If you wanted to do a valuation as of that date, then you could go back and use that balance sheet date. But then you'd have to back in the data for the cost of capital as of that date, because the WACC that we're going to use is also a current WACC. So we'd have to go search the historical WACC to do the value of that as of that date. All right, so that is the DCF valuation. Now, in just a minute, we're going to do this, but we're going to do the EP valuation first. On my ratios tab, I'm going to put my forecasted price per share as a reference.
So on the ratios tab?
On the ratios tab. So I'm just going to put down here at the bottom of the ratios tab, just a reference, equals that price per share, equals the forecasted price per share on the DCF tab. Here's why. Because Coca Cola let's see. It's trading at $42 a share today. And right now our model says it's worth 24. So one of the things that we're going to have to do is we're going to have to start changing our assumptions to get closer to the current share price. Okay? So the way we're eventually going to change our assumptions is we're going to do this. Instead of shrinking at 2% a year, what if Coke grew at 2% a year? Well, notice that the share price changes. Right? Don't do this.
Okay.
Not yet. This is once we're done, this is what we're eventually going to get to. But I'm setting it up so that we can do this. So that's the whole point, is that we're going to start doing what ifs. As things change, we can see the impact on the share price. That's what we're setting up for our ability to do on the model. And rather than jumping around too much, I'm aggregating the data in one place so it's easier to see. Okay? But the real work in the valuation is eventually going to come back to this ratios tab, because it's our assumption of these ratios that are going to matter to the real value of Coca Cola. But for now, I'm going to undo that change, leave it at $23.94, and we're going to finish out our valuation. Because there's one more tab we got to do, which is we have to do an economic profit valuation. Because I told you you're going to be responsible for doing two valuations this semester, a DCF and an economic profit, and you have to show that they balance. So we're going to do the same thing in our model. We're going to add in the economic profit valuation of Coca Cola. So the easiest way to do this, and again, if I go back to the Home Depot example, this is where, using Home Depot, McKinsey did the economic profit valuation of Home Depot. And what we had said is the major difference between the DCF and the EP valuation was how the operating value was calculated. Right, that was really the only difference. Everything else was going to be the same. So the easiest way to then handle that in our model would then be to take the DCF valuation and clone this tab. Because everything is going to be the same except how we calculate the operating value. And so rather than redoing the whole thing, we're just going to redo the operating value. So to clone a tab with your mouse, you right click on the tab in Excel, click on Move or Copy, check the box that says Create a Copy, and put it at the end. So we now have a copy of the DCF tab, DCF tab 2. And then we just want to click on the tab name to rename it. And instead of DCF valuation, we're going to call it EP valuation, or the economic profit valuation. So again, what we have is we have a clone of the DCF tab as our starting point. So what's different about the economic profit valuation, working in the EP valuation tab, is that instead of forecasting free cash flows, we're forecasting economic profit. So I have to clear these contents. It's at the same discount rate, but when we discount the economic profits, instead of discounted free cash flows, we're going to have the discounted economic profits. So that's what's primarily different about the valuation. Remember, economic profit is the change in value. So we have the change in value year by year. Again, key point. In order to get these two valuations to match, the economic profit needs to be based on beginning of year invested capital. So we're going to use the EPBOY tab. Right, if you use average capital, or if you use end of year capital, you get close. If you use beginning of year, you get exact. So for purposes of showing you the exact nature, we're going to use the beginning of year economic profit calculation. So 2014, based on, remember, BOYEP, the economic profit, always after goodwill when we do our valuations. So again, 2014, row 23, so G23 would be the first number. So equals, make sure you use the BOY tab, G23. 2015, BOY, H23. 2016 economic profit, I23. 2017, J23. 2018, K. 2019, L. 2020, M. 2021, N. 2022 is O, and 2023 is P. So, double check this. G, H, I, J, K, L, M, N, O, P. So what I now have is, instead of the operating value, I have the change in value for the first 10 years in present value format. So in the first decade, Home Depot is adding $33 billion worth of value based on our forecast coming true. That's what the economic profit is telling us. Then what I'm going to do is I'm also going to say, Coca Cola is, not Home Depot. I think I said Home Depot a second ago. Coca Cola is adding $33 billion worth of value. Then I have to add in two more things. What is the value they add in the continuing value period? And then finally, what is their beginning or starting invested capital? So the key to economic profit valuation is what capital do you start with, and then how much value do you add or subtract to it over time? So the starting invested capital would be the current invested capital off the TFI. That would be the 2013 operating invested capital, including goodwill, G7. So that the operating value would be the sum of these three items. The first 10 years, the continuing value, and the starting invested capital. Now, here's the thing. The formula for continuing value is different for economic profit than it is for free cash flow. So McKinsey rearranged the key value driver equation to take into account economic profit. So again, this was talked about in the book, but the short answer is this was the formula for key value drivers of free cash flow. This is the formula for key value drivers, economic profit, continuing value. So basically, we have to put this formula with the correct order of operations into our model. It's probably the hardest thing you got to do in building the model. Right? So there's 5 things in this formula. There's economic profit, T plus 1, right? Because basically we're doing the beginning invested capital plus the first decade plus the continuing value, right? So in this case, economic profit T plus 1 would be our 2024 economic profit. We need our WACC, which we already have. We use the no plat in T plus 1, which we already have. We use the G, which is the same G. We use the RONIC, which is the same RONIC. So really the only thing that we're missing that's new in the formula is the economic profit in T plus 1. So what I'm going to do is I'm going to go back to my assumptions tab, and I'm going to do continuing value economic profit. And that is going to be BOY, economic profit, 2024 economic profit after goodwill, so it's the last row, in 2024, $4,066,000,000. So I now have the 5 things in the economic profit here. So I'm ready to build my formula. Now, when I finish building my formula, this operating value should match this operating value. If they don't, I've made a mistake. So to make sure that I don't make a mistake, what I'm going to do is I'm just going to put in my little check here. My little check is going to say, take the DCF operating value, subtract the EP operating value, and that should be 0. Now here's the other thing. What I've just done is I've actually back solved for this number. So I can already tell you what that answer has to be. That's the present value of the continuing value of the economic profit, right? Except for purposes of your exam, I'm not going to accept that as a correct answer. You can't just back into it. You got to show me that you actually do the formula correctly, right? So here's the thing. Let's do the formula. So for economic profit, cell B14, continuing value, what I'm going to do is I'm going to take equals, left paren, and I'm going to take economic profit divided by WACC. So off my assumptions tab, the continuing value economic profit divided by the continuing, or by the WACC. Right paren. Plus, now I got to do this mess. So left paren. No plat. Times left paren. G divided by RONIC, right paren, times left paren, RONIC minus whack, right paren, divided by left paren, whack times left paren, whack minus G, right paren. Assuming I have the correct order of operations, I get 84,699.8, which discounted is 39,966.4, which gives me an operating value of 102, which is identical to any number of decimal places to the DCF. Rearrange math. By the way, that's that formula.
Yes.
So as I said, the formula is the hardest part, is entering in with the correct order of operations in Excel. But that aside, the theory here is what really matters, is that the idea is that if I do two different methodologies, I should still get the same valuation, and that's what we're kind of proving out here. So this is the change in value methodology, the economic profit. The other one's just an NPV. And if I take my capital and I look at the change in the value that I'm adding or subtracting the capital, it has to equal to the DCF of the NPV, of the cash flows. So basically, that's all we're proving out here. We're proving out that the math works out. Right? This, by the way, is your final exam. Just so you know. So you did the conversions on the midterm. So when you do your final, I'm going to basically just give you the same or a similar statement to you at the midterm, and then you got to finish it out and do the valuation and show me you get the same answer. Questions? All right. So what we've done, for all intents and purposes, is completed most of the valuation model. We've actually done the valuation, right? So if we go back and we review what we've done is we've taken the Bloomberg statements. I'll save what I've done. We've taken the Bloomberg statements. We've put them into our model, income statement and balance sheet. We've then converted them to the economic statements. We then use the ratios to forecast, creating the forecast to converted statements. And then using the forecast converted statements, we've just created a valuation, both a DCF and an economic profit valuation. So again, a lot of numbers on this tablet or on this Excel spreadsheet, but nonetheless, it should be a relatively straightforward process for what we have done. Right? Now, we're going to start moving from science to art, right? Because the science of the valuation is what we have done. We've now gotten a correct answer, assuming all of this data comes true. But the real key to any valuation is your assumptions, right? Because the math is actually straightforward. What we have done should seem very straightforward to you. There's a lot of steps, but it's relatively straightforward. It's just a big NPV, glorified. Right, we got cash coming in, we got cash coming out, we got a discount rate. We're just trying to figure out what the cash coming in, cash coming out is, because accounting is complicated. So we're just taking that into play, and we're coming up with a big NPV. Then we're going to have to get into, as I said, figuring out what the real assumptions are to make to get a realistic valuation. So, yes.
So what is maybe I just missed it, but what's the theory in the next 10-year valuation between the two models? And what's really the differing factor?
So in the DCF valuation for the next 10 years, what we say is, here's the cash flow that you're going to generate in the free cash flow that you're going to generate in the first 10 years, and here's the free cash flow that you're going to generate in years 11 going forward. Just value that. In the economic profit, it's here's the capital you started with. Here's the change in value of that capital in the first 10 years. Here's the change in value of year 11 going forward. Add those two changes of value to the beginning capital, and that's the ultimate value of the firm. So the major difference is free cash flow valuation is literally just saying, I generate cash flow, I value the cash flow. Economic profit says, I put in a chunk of change, put in this cash, take that starting cash and say, am I adding value period by period to that starting cash, or am I taking away value period by period to that starting cash? And I'm just literally adding up all those changes in values. And so that's the idea of economic profit valuation.
Yeah,
so
so
they give me the same result.
Yeah, so on economic profit though, so if you take the first 10 years, just kind of back, and the beginning invested capital.
Mhm.
So the free cash flow model, the assumption is that that's implied in your free cash flow. So here you combine the two and it's a $62 million valuation.
Mm-hmm.
What's the theory and why that's higher than the 50 million on the other discounted cash flow?
Well, in this case, what it says is,
More current value in that one as opposed to the other.
well, just think of it as just more as literally what it's telling you. In the free cash flow, you're generating $52 billion worth of cash in the first decade. Okay, that's how much net cash you're going to generate. And in the economic profit value, it's really a different metaphor, but what it says is we spent $30 billion, $29 billion worth of cash historically, and we're going to add 33 to the value of that. Now, here's the thing. The cash flow and the value are not necessarily the same thing in the short run, right? And the reason why is because of a timing difference. And the timing difference in the valuation equations has to do with this initial $29 billion of historical cash that's been invested. Because remember, in a DCF, that's a sunk cost. So in a DCF, we don't consider the $29 billion. We only consider how much cash you generate going forward. Whereas in economic profit valuation, we start with what you've spent. To some degree, we start with the sunk cost, and then we look at the change in value of the sunk cost over time. So assuming that you have positive cash flow, the DCF is going to take a while before it catches up with the economic profit valuation, just because you have that starting value with EP that you do not have with DCF. But that's why with EP, what you're doing is you're using a spread. So you're taking out essentially the expectation of the cash flows, so you're getting lower on the initial amount of investment. So you're actually getting lower economic profits than the true free cash flow of what's incrementally being invested, because you're actually recovering in a way in the EP valuation that sunk cost. Where the free cash flow model says it's incremental and you don't do it. So again,
Which is why then your continuing value is really just a back solve total.
To some degree, yes.
From beginning to end.
Yeah, exactly right. But again, what the real reason we do this is it gets to a concept which Stern Stewart calls market value added, which says that Coke put $29 billion into the firm. Coke is worth 102, assuming at this valuation. So Coke has added $70 billion more than what they originally spent. And the reason that becomes important is some companies could be valuable just because they invest a lot of money and they own a lot of assets. And some companies could be valuable because they take a little bit of assets and they really use them exceptionally well. And that's what I want to tell the difference of. As a matter of fact, Fortune used to every year, I don't even know if they do it anymore because it's kind of fallen. People gotten bored, I guess, of the article. But they used to have a list of what they called America's Wealth Creators, and every year they'd list like the Fortune 500, but then they do it based on MVA. So they'd say, who are the biggest wealth creators? They'd look at the market value of the assets minus the book value of the assets, and that would basically say that those were the value that was created. And it used to be, when they first started doing this back in the 90s, the big wealth creators were companies like General Electric and Walmart. And the reason why General Electric and Walmart were big wealth creators is because they were behemoth firms, and they had huge asset bases, and they were adding some value to the huge asset bases. But if you look at the values today, the big wealth creators are IT firms. It's Google, it's Facebook. To some degree, it's still Microsoft, it's Apple. And these companies don't have to have nearly as much investment, yet they're generating huge cash flows out of the little investment that they have. So you've actually seen a complete change in what's being valued today. And I'm not saying that companies like GE and companies like Microsoft, Walmart aren't valuable. It's just they're using a lot of assets to create the value, where Apple hardly uses any assets at all because they're outsourcing everything. And so they're just an IP firm. Same thing with Facebook. Facebook's an IP firm. And that is extremely valuable in today's market. They're getting there two different ways, and they have two completely different EVAs. Good question, though. Other questions? All right, so here's what I want to do. I want to finish our evaluation, we need current data. So this goes back to the Bloomberg data that we had exported last week. So what is on the file section of Coke? This is the data and the screenshots that we had taken last week from Coke, and we just want to make sure that this is now updated in our model, right? And the reason why I waited till the end to do the update is because I want to show you the repeatable nature of using this model, because we're going to update the most recent data for Coke, but it could just as easily be Pfizer or Merck, right? And so that's the key, is that now we have the model, now we can always use this model as a basis, as long as we continue to do the relative reference to value anybody. So the first thing we need, and I'm going to go off of these statements, is to make sure we have the historical income statement data. So this was the exported income statement data from Coke that we had from last week. So again, making sure that we had no NAs, because NAs are going to cause our model to choke when Bloomberg does not availables. So make sure those are zeros. But assuming we do that, select the tab, copy the tab, come into our model, go to the Data IS tab, select the tab, Paste Special Values. So that should essentially, and very key, paste special values. If you copy and paste between two spreadsheets, Excel, trying to be smart, will make references to that other spreadsheet. And it will always be looking for that other spreadsheet. So in order to copy without making references to the other spreadsheets you're copying to, don't just copy paste, copy paste special values, because then you're just moving the numbers in, right? And then you want to overwrite field by field. Same thing for the balance sheet. So we want to make sure we have the most recent balance sheet data. So again, we go to the balance sheet data that we exported last week from Bloomberg, select the whole tab, copy, come in here, select the whole tab in our model, paste special values. Cash flow. This is the GAAP statement of cash flow. Again, this was the Coke CF. Select the tab, copy, paste special values. Okay. So that's basically what we're going to need to do to update our models. This is what you'll have to do for your group projects. You'll basically export the data from Bloomberg and then basically update the model by copy paste special values for those three tabs. Right? Then we have to go to the assumptions tab, because these assumptions could change by company and they need to be the more current assumptions. So that's why we put them in the assumptions tab. So the first thing we have to do is we have to check the last reported year. Right? Now it just so happens that Coke's last reported year was 2013, but let's say we did this same model a year from now, we'd have to change the last reported year in our model to 2014. That's how the model knows to keep the years correct. All right, so I set that up as an assumption. Operating cash as a percentage of revenue, we're going to leave that at 2%. The next one is our WACC. We need a current WACC. Well, as of last week, when we did the WACC screenshot, Coke's WACC 7.2%. So what we're going to do is we're going to come to our model and we're going to say 7.2%. Right? We're not going to update the continuing value, no plat, G, or ROIC at this point. We're not going to update the price to book. We want to make sure we have the current shares outstanding, which we actually did earlier today. That was off the DES screen. Shares outstanding. Current shares outstanding, because we're doing the valuation as of today. Right? Then we don't need to do continuing economic profit, but we have to come down here to these numbers. So this is, again, solving a Bloomberg data problem on the export side. So because when Bloomberg changes companies, the reference items section of the balance sheet is not always the same. And so what I mean by that is one of the items we're going to care about is goodwill. Goodwill just happens to be on row 67 for this export, but it may not be on row 67 for another export. That causes problems for us. So I can't refer to the goodwill that we need in our model to the row 67 if it's going to change. So the three numbers in the reference item section that aren't always on the same row that changed are goodwill, pension, operating leases. So what I need to do is I need to update those. Okay? So again, here's a challenge that I forgot about. So I need to do it right here. Do it the easy way. Well, because here's what I'm going to say. Basically, they go from oldest to newest here, but they go from in here, but they go from newest to oldest here. So I can't just copy and paste, unfortunately. So this is what I will quickly do. So I'll take column F, cut, paste, easiest way to do it. There's an easier way, but without doing Excel formulas. X, cut, paste, cut, paste, cut, paste, cut, paste, and then take this whole thing, don't copy, cut, paste. Undo. Take all of this. There we go. And I'm going to insert a row just so it's not completely confusing. Well, I'm sure people following the video like what just happened. Equals 2013. So this is the 2013 operating lease data. This is the data for 2008 pension and goodwill obligations. Get rid of the yellow there. Now you might say, why did I do that? Well, here's why. Because then what I'm going to do on the balance sheet, starting in 2008, for goodwill, take my goodwill, 2008 to 2013, copy it, assumptions, paste special, values. For my pension obligations, copy, assumptions, paste special, values. And for my operating leases, current values, the only one I really care about. So it's this line or this row. Copy, paste special values. Now you notice that those numbers were already copied and pasted in, but nonetheless I just wanted to show you the process if you were updating it for your other company. Right? So this is essentially now the valuation model that we will use for valuing a company. Right? And what we're going to do next after a break is we're going to do and prepare to do what's called an as-is valuation of Coca Cola. And an as-is valuation means the company is currently trading at $42.19 a share. So we want to get really close to that. And I'm going to define that as within $1. Okay? So we want to basically understand what assumptions the market must be making in order to value Coke at the current price. Right? So that's what we're going to do. In this class, we're going to always do two valuations. Right? Valuation number one is called the as-is valuation, which I just described. Valuation number two is our own opinion, which will be called the final valuation. So regardless of your opinion, I always want you to use the valuation model that we create to value the company at its current price, whether you agree with it or not, because at some point, that's the price. Like somebody's paying for that today. There has to be some rationale behind that. So what we're trying to do is we're trying to figure out what cash flows justify that current price, as is valuation. Now, if we disagree with those assumptions, we can create a second model which has our point of view. And by the way, the difference between our point of view and the as-is valuation is the nature of the buy, sell, hold opinion. Because basically the hold says that we think the market's got it right and that the cash flows actually support the intrinsic value of the company, and so therefore it's fairly valued. So there's not really a reason to buy it or sell it. It's fairly valued. You hold, right? And then the buy basically says that our opinion says that the market's got it wrong, and over the long run, the company will generate more cash flow than the market thinks, and so therefore it's a good time to buy. And then the sell is the exact opposite, which is the market is being too optimistic about the cash flows and versus what we think will actually happen, therefore sell. Buy, sell, hold. Okay? And that's really what you're seeing communicating by the analysts when they write those opinions. Now, two things about that. They usually use a trading range of 10 to 15%. We're going to use 10% for the holds, just because there's vagaries in what's happening in the market every day. So you don't want to literally do it, price is 43 and then goes to 44 and then suddenly it's a sell. Like, that doesn't make any sense. It'd be too chaotic. So that's what we said. Plus or minus 10 to 15% is what most analysts use for the holds. We're going to say plus or minus 10% in this class.